The central subject is addressing the process of financialization over the long run, mainly since the third part of the 20th century. The central idea is to clarify this complex macroeconomic phenomenon by interesting it into the concrete dynamics of organization. This organization-based approach sheds light on deep financial dynamics that most of the classical work on financialization often neglects. First of all, this concept is now broadly and increasingly used by scholars in management, sociology, economics, in social sciences in general. Hence, it was a great interest to organize a multidisciplinary event, and that's why today we are so many from various disciplines, and it constitutes the richness of this conference. The financialization is usually defined as the integration of rationalities, instruments, indicators, and actors from the financial sphere into non-financial organization. Some scholars sometimes give the two broadly used macroeconomic definition of financialization from Krippner and Epstein, but before developing some microeconomic aspects. And it remains difficult to find a specific definition that can be operationalized in specific research due to the plurality of domains concerned. Just to mention the three well-known domains from Natasha van der Zwaan: the macroeconomic accumulation regime, the transformation of business strategy, and the daily life of individuals. The concept of financialization acts sometimes as a simple backdrop for research. In this respect, we have the feeling of a concept which, like neoliberalism and globalization, is used to point out such diverse phenomena that it finally results in considering capitalism as a whole. To quote a famous socioeconomist, Neil Fligstein, one could make the case that shareholder value, as a description of the core dynamics of capitalism, has run its course. That would be to say that the research program on financialization have not made decisive theoretical progress since the transformation of corporate control. The way to overcome this situation is to take a further step back, to reconfigure the concept of financialization and to change its function. It should no longer be considered as a coherent explanatory variable, but rather as a shifting result, itself to be explained by multiple causes. Organizational dynamics provide a central point of access. The majority of researchers on corporate financialization see organization dynamics as a set of adaptation to exogenous change. This process is usually based on abstract and diffuse conception of finance, leading to an overhanging perception of finance transformation. The explanation tends toward a single causal direction. Finance markets would be self-imposed on organization. For instance, the reinforcement of institutional investors among the capital of large companies is frequently interpreted as a decisive factor of their strategic reorientation. Nevertheless, the institutional investors are often subsidiaries of traditional investment banks. The executives of this large corporation usually maintain close and long-standing relationship with those banks. They collaborate to develop their strategy, and the break between the two words is not always so clear in practice. Start the reflection from organization dynamics is a way to better understand how financialization is concretely shaped, but also to consider the endogenous dimension of this process. In this respect, it's necessary to adopt a deeper historical perspective. Diachronically, financialization is often presented as a substitute for past productive model based on industrial accumulation and Keynesian regulation. Financial neoliberalism is used to have replaced industrial Fordism during the 1980s through a major economic and ideological transformation. This so-called shareholder revolution can be summarized with the conception of Michael Brawoy. I quote him. As a hegemonic move which is central to the reassertion of capital, a development that is symptomatic of a shift toward a more despotic mode of capitalist accumulation, where the whip of the market, allied to the notion of possessive individualism, free choice and self-determination, progressively replace the velvet glove of the cooperative state. However, change associated with the shareholder value revolution are based on a previous evolution, notably linked with the emergence of conglomerates and large Chandlerian organizations in the 60s. This is what Fligstein had already developed in Transformation of Corporate Control, with the idea of financial conception of control. Nevertheless, this earlier stage have only received little attention from scholars. It is especially necessary to consider the continuities, since his historical rupture had been considerably nuanced, particularly in France. In contrast to an exogenous financial invasion, pushing from various forms of liberalization, the state has accompanied this development not toward unbridled deregulation, but rather toward the construction of other financial regulation. By considering the deeper historical dynamics of financialization, other historical breaks appear. For instance, if we consider the ratio of market capitalization on GDP, it appears that after a decline that began after the First World War, the French financial sector returned to a growth dynamics during the 50s. There was intense activity in the Parisian financial place between the 1950s and 60s. And there was intense activity until the stock market crash of 1969. And this led to a major financial downturn until the end of the 1980s. It was not until the end of the 90s that this ratio of market capitalization to GDP reached a level comparable to that of 1913. The suffix financialization implies irreversibility, a substitution to one form for another. Financial systems seems to impose on the organization pre-existing management tools perceived as less financial. The interplay between financial rationality and other forms of rationality is rarely discussed in detail. The diffuse and overarching conceptualization described above overhands the role of the actors who concretely construct the dynamics of financialization. Many individuals and organizations are in the interface between non-financial organization and financial markets. The private equity fund, the M&A advisor, the financial analyst, the journalists, the corporate lawyers, the traders, the financial regulator, etc. Their logic of action, tools, and rationality are now well documented. But their action on organization is often perceived as obvious. Yet, there are power relations between actors to impose their perception their tools in order to access to dominant position in their field. Their representation constitutes the legitimate symbolic support to their action and are subject to this power relation, to this tension and renegotiation. The action of finance managers cannot be understood as belonging to a simple rationality imported from the financial sphere. If the analysis remains there, it seems to confer an intrinsic and magical power to financial logic. On the contrary, the papers of this conference highlight that there is a plurality of financial rationalities under tension, constructed and interpreted by actors who have an interest in their strategy. This conference provides some answers as to the meaning that long-term financial transformation have for the actor, who set them in motion, the interests that are intertwined with them, and to the contradictory forces that shape these dynamics. Working in this direction implies understanding the opposite direction of causality, asking not how finance imposes itself over the real economy, but at the end how all these organizations and actors produce financial capital. Finally, concerning the work presented, we have 23 contributions. I would like to reiterate the very high average quality of the papers. The issues that will be addressed are both stimulating and diverse, but they also reveal the main driving force and transversal concern of the scholars. Some papers analyze the link between the evolution of finance and value through the notion of ethics, but also the transformation related to the development of new sectors, such as a peer-to-peer platform, as well as technological innovation, supported by startups that are prey to the domination of investors. Additionally, the way in which the subprime crisis has reconfigured power relation and exacerbated the predatory nature of financial lenders is addressed. Some papers focus on the link between the company's financial structure and their performance. Several other papers develop the practice of financier at work, to reword Valérie Boussard, and some highlight the political role of financial institutions. Then, 7 contributions focus on the transformation that have taken place within the state itself. It is a central actor that has brought about major financial transformation. This emphasizes the interest for regulation issue. Several papers investigate the change in power relation within economic and financial elites linked to financialization. Finally, the concern for historical dynamic, which is at the center of this conference, is explicitly raised by several contributions, which address interaction between industrial, financial, and state dynamics over a long or shorter period of time. In terms of historical boundaries, the earliest contribution, which is temporarily quite out of date, examine financial mutation during the first decade of the 19th century. Nevertheless, most papers focus on much more recent historical dynamics, essentially from 80s and 90s, and very few from the 70s. This analysis on the scope of company, organization, public institution or sector will contribute to shed light on the endogenous construction of financial mechanism and rationality. They will contribute to demonstrate that managers, regulators, historical shareholders of non-financial organizations were not always the victim of external financialization, they in fact contributed to its development, and to a certain extent, they called the shots. Thank you for your attention.
I want to kind of pick up this issue about shareholder value capitalism and its relationship to financialization. And the way I want to do it is I want to talk about exactly what shareholder value capitalism was and how it worked and what its effects were. I want to talk a little bit about the dynamics. And one of the things I think has happened in the literature is that people assume that once this thing gets set up, it just keeps going. But the problem is that if you're going to worry about the share price, a set of strategies you take to do something are only going to work for a while, because then they're going to get factored into the share price. So for example, in the United States, one of the things that corporations did is they stopped giving people health insurance. And that saved them a lot of money, right? And that money went right to the bottom line. And the stock got factored into the stock price, right? But once you've done that, then, you know, what's the next trick you're going to play to keep the stock price going? And I think the dynamics of shareholder value, once you get locked into it, are less about finance in a kind of abstract way and more about the kind of demands being placed on managers to constantly pay attention to that. And we see that as these tactics evolved over about 40 years. So I'm going to kind of do that for you. And then my kind of point is that I often think, particularly in Europe, that people see shareholder value as something that's here, and it is in some ways, but it's mostly been an American phenomena. And as I said, it's continued to evolve as the need to raise stock prices never cease. Another kind of interesting point, which I think goes to something that was just said too, is that I think people see that the financial markets control the managers. But actually, it turns out that the managers came roaring back. And in fact, the managers have been the biggest beneficiaries of shareholder value capitalism. They're the ones who got the richest. What happened was that CEO pay in the United States in 1980, the average CEO made about 40 times the average worker. By the time you get to 2000, it's 300 times the average worker. And this is because they worked out a deal, and in that deal, the managers became shareholders, and in becoming shareholders, they became greatly enriched. And so the managers are really implicated this in a strong way. And so they're not just being told by a financial market, do this, do that. They're going, wait a second, if I do this, the stock price goes up and, you know, I'm rich. I think that financialization and the idea of shareholder value capitalism have a complex and not well understood relationship. I want to kind of pick at that like a little bit like a scab, you know, pick off the pieces for you today and say a few things about that. And finally, I want to end up by talking a little bit about how shareholder value capitalism has morphed in different directions. And I actually think we're at a historical moment where it's kind of interesting, at least in America, to understand what are the main dynamics of American capitalism for companies. And I'm going to do that in 45 minutes, right? So what is shareholder value capitalism? Well, kind of the classic way that people have defined it is shareholder value capitalism conceives of the corporation as an entity that can be managed to maximize shareholder value, defined as undertaking actions to increase the stock price. One of the things that's really interesting about shareholder value capitalism is that it's kind of indexes 4 different things, which are relevant to the discussion about financialization in different ways. First of all, it is about a power relationship between financial markets and financial institutions and share owners and management. And that power did shift in the United States dramatically in the 1980s. There's no doubt that power shifted. The second is it also acts as an ideology. And one of the things that managers learned really quick was how to talk the talk. And if you went back, for example, and looked at annual reports of corporations between about 1980 and 2000 and go looking for the term shareholder value in those, this might be, publicly held corporations in the United States every year issue a report documenting what they have done in the past year. And then there's usually a statement from the CEO saying, grandiose things about what they're going to do. Well, that word shareholder value kind of comes in, right? And they learn how to use that word to describe what they're doing, to explain to shareholders and to, hey, stay with us because we're trying to maximize the share price. And so it becomes a kind of ideology. Third, it is a set of business strategies that define what kind of actions managers will take. And as I mentioned a minute ago, those strategies evolve over time, and they're not all just simple financial ploys like managing the balance sheet. Though managing the balance sheet is one of the things that happens. And I'll describe some of that in a few minutes. And finally, and I think this is a part that's kind of leaked over into financialization, is that shareholder value is a kind of framework by which managers use financial analysis and the data and statistics related to that form of analysis to communicate with financial communities. And I think this is one of those things that's a little less studied. There's some interesting work that shows that what happens in business schools in the United States in the 1980s is that you move from business schools teaching something called general management to business schools teaching something called finance. And if you go to American business schools, like the most important ones, what those MBAs came in there with is they wanted to learn how to do finance. And maybe you guys have that same problem now. Yes, I think you do. I've talked to enough of you that I know that you all have that same problem. And that actually is the thing that really keeps this going, right? Because you have a whole generation of managers which now learn to talk this talk, right? And then when they get employed and they start making their way up the company, they walk that walk. And I think at this point, one of the things that keeps a lot of this alive is this way of looking at the world, whatever you want to call it, a framework, a way to simplify the world, a set of market devices, whatever your commensuration devices, whatever you like to say about it. But it's been very important in the maintenance of it and the spread of it because it creates a common language. And I do believe you've raised 2 generations now of managers who talk this way, right? And who think this way, and this has a big impact on what they do. So one of the reasons that I think that shareholder value capitalism has been primarily an American phenomena is because the precondition for shareholder value capitalism is a market for corporate control. And I think this is a really, really underappreciated fact that a stock market is a place where publicly held joint stock corporations sell their stock and as a result become the possible targets of mergers and acquisition. These transactions can be friendly or hostile. In places like the United States or Great Britain, historically, stock ownership has been dispersed, and the largest shareholders only have 5 to 10% of the stock. And what this has meant that if someone wants to buy a firm, they can do so by making an offer. And so what's playing out the last couple of days, maybe you guys have been following this thing about Twitter, right? So the richest man in the world decided about 4 months ago he was going to make a crazy offer for Twitter. If he wanted to spend $54 billion on Twitter, I personally say let's see if we can destroy his fortune. But he decided to do that, and that's America, right? He decided to do it. He made that bid. At first, the Twitter board kind of said, "Well, we don't want you to do that." And then somebody said, "Well, wait a second. Shareholder value capitalism says we're only worth $40 billion, and this guy wants to pay $54. We got to take that offer, right? We got to do that." And that's the way shareholder value capitalism works. And I think if you start thinking about in the European context, some places, sometimes you see those things in places like France and Germany and other places in Europe, but not very often. And the reason is that you don't have this market for corporate control. And that's really a really critical element to this. Without a market for corporate control, the invasion of institutional investors in the stock market couldn't have happened. One reason shareholder value capitalism was, as I say, was not widely developed outside the U.S. is because this is a big impediment. There very famously in the 90s, Boone Pickens, who was one of these guys who raided companies, went to Japan and tried to bid up some companies that were undervalued to buy, and discovered very quickly that all the shares were in or held by Japanese Keiretsu, and he couldn't do it, right? And lost a couple $100 million and walked away from it. And I think that which shows you how, I think the guy would have known something. it shows you how difficult it would be to import such a system. And I think that also explains the persistence of these national models, the varieties of capitalism and the national social welfare models. So let me go ahead and riff this out a little bit more. In the U.S., between 1950 and 1980, the market for corporate control was actually dominated by the managers of the largest corporations. And so the merger movement in the 1960s in the United States were managers of sitting firms buying other managers of firms. And they were mainly engaged in diversifying their products, and this created the conglomerate merger wave. So that the habit of hostile and friendly takeovers was there already. In fact, you can go back into the 1890s and see the early parts of this. But in the late 1970s, I thought it was really interesting when Quentin put that graph up there. You can see there's a kind of flex point in the 80s. Everything's kind of going down. And that was because of the 1970s, which were bad economic times for everybody. Slow growth, high inflation, and low stock prices, everybody in developed countries. This prompted a set of institutional investors in the United States to buy firms, break them up, and profit. And they were able to do so because of this market for corporate control and some financial innovations by which they were able to raise money, what we call now the junk bond market. They were able to raise large sums of money. They would buy something up, they would break it up, they would pay off their debts, and they'd make money off the deal. That was the beginning of all this. These institutional investors transformed the power relationships. They made the argument that sitting management teams had let stock prices fall too far. They weren't maximizing shareholder value. And they engaged in a merger movement that transformed American capitalism. I like this slide because it sort of illustrates that. So this is a slide that looks for the words shareholder value in titles of articles in the Wall Street Journal, which is the main American business press, right? And what you can see here is, you probably can't read this, but if you go back to about 1980, there's little tiny numbers, and then all of a sudden, about 1983, the thing just takes off, right? And in the 90s, it goes down at the end of the merger movement, which is where that thing goes down a little bit. But then there's another merger movement, and you can see shareholder value is now kind of that's where it gets introduced into this conversation. There is an interesting debate about whether agency theory and shareholder value, the agency theorists caused shareholder value. I think it's been pretty much historically established that when this started, these people weren't using agency theory. It was a later intervention. Michael Jensen made an intervention in the late 80s and early 90s and kind of gave them ideological cover for it. It was not really their main motive at that time, and I'd be happy to answer a question about that if somebody wants to hear a little bit more. So, as I say, in the world before 1980, top managers controlled firms, made investments, engaged in mergers and acquisitions, and formulated corporate strategy. Boards of directors were frequently appointed by top management. They listened to managers and felt they were closer to the situation and generally respected their power. If you want to think about this in a power sense, the board of directors and CEO and COO of the firm dominated the financial markets, dominated institutional investors, and dominated the way in which stock was bought and sold. That's kind of the way the world looked. But with this institutional investor activism that began in the late 1970s, they began to demand seats on board of directors. They wanted corporate strategy to focus on actions that would increase the share price. They wanted to tie managerial pay to performance to increase the share price. These were all things that people came around to do. There was the amounts of money that were made in the 1980s is ridiculous. I could tell some stories about what exactly happened, but if somebody wants to ask some questions about that later, it was pretty amazing. So it sort of flipped the power relation. So if the power relation had been going from the firm to the markets now were kind of telling the firm, this is what we want. And if you had a hostile takeover bid, I have a graduate student working on a dissertation about this. So there was a lot of contention here, and the managers fought back. And I think this is one of those episodes that was kind of under or unappreciated, is that the managers didn't like this takeover thing, right? Because they would be out of a job. And so they fought it at the beginning. They tried to prevent, they created something called a poison pill, which is a financial device to help them out. There were a set of lawsuits. In the United States, almost all publicly held corporations are incorporated in the state of Delaware. And what that means is there's a court in Delaware that decides everything to do with these corporations. And that's actually where they're going to, where Elon Musk is fighting Twitter's in this court in Delaware. And if you read these articles carefully enough, you'll see that it's called the Court of Chancellery, and it's in Delaware. And in 2 weeks, this trial is supposed to start, and it's going to end really fast. And the court's either going to decide that he's got to do this or that he doesn't. And one of the reasons there's been all this movement in the last week or so is I think he knows that he's going to lose. And so the question is, which law? Is he going to do it, or is he going to take the loss that he's going to have to take to make? But you can see how powerful that court is. The court has generally upheld shareholder rights. On the other hand, they've also upheld management rights. And the reason is that they assume that unless managers have done something illegal, that managers know more about what's going on, they know more about the business conditions, they know more about the business, and they're not going to step in and just accept that shareholders can come along and do this without some kind of managerial backing. And this has created a kind of truce. I would call it truce, compromise, grand bargain. And in the early 1990s, after these cases were decided, managers agreed to maximize shareholder value, and they were rewarded with high salaries and stock options. And managerial pay moved in this direction that I talked about a couple of minutes ago. So a lot of this financialization that people talk about comes from this era. Managers who were trained in finance became the conduit of information that met expectations of the financial community, communicating with institutional investors via stock market and analysts, and quarterly phone calls became the norm. There's a thing that happens every quarter in the United States where the chief financial officer gets on a phone call with all the stock analysts and explains how much they're going to make next quarter and says how they're doing and stuff like that. The chief financial officer becomes an important person. There wasn't a title of the chief financial officer in American companies before 1980s, but this became the kind of spokesperson. And finally, this was supposed to help increase interest in the stock and raise the stock price. I want to kind of turn to the second part of this. So what exactly do these guys do to maximize shareholder value? And they undertook a set of tactics over the next 20, 30 years. And I'm just going to list them, and then I want to look at some of their impacts. So the first thing that happened in the 1980s was the buying up these firms and de-diversifying them and breaking them up and selling the pieces. And this divestiture pleased analysts. People made a lot of money. There was a lot of companies that were undervalued. So you could buy up $1 billion worth of assets and sell it for $3 billion, things like that. And if you borrowed the money to buy it, then you paid it back, whatever it cost you interest-wise. Didn't matter if it was 15%. If you did it in 2 years, you made a boatload of money, right? Everybody, maybe you guys already know all that. Sold off divisions in industries that were not growing, bought market share in industries that were growing, laid off workers, particularly unionized workers, invested in technology. The 80s was a period where American unions were already falling apart by the time you get to 1980, but their demise by 1990 was pretty much there. You reduced pay and benefits for workers. I'll show a little bit about that. You outsource production for cheaper labor, globalization. The whole globalization thing takes off as a result of this kind of way of thinking. You reduce layers of management to save money. So after you get rid of the workers and you sell off the factories, what are you going to do next? Well, now all of a sudden you got to look, well, where are we going to get our next hit for the shareholders? So what you do is you remove a layer of middle management, right? You just say, we're going to fire these guys. Next quarter, all that money you paid them goes right to the bottom line. And is everybody following me there? And the stock price goes up. One of the reasons that George Bush's father lost the 1992 presidential election in America was that there's this great statistic where the managers of 45 to 54, 50% of them lost their jobs in 3 years. And if you want to think about the core of a center-right party, those got to be the the core of a center-right party, right? And they were out in the street, right? And that also was the beginning in America of what we now call 24/7 work, which was, just because you got rid of all those managers, it wasn't like they weren't doing something, right? So who was going to pick it up? And what happened was everybody worked more and they worked more hours. They got higher pay, but they worked more hours and then they were on call. And those events actually are coterminous. And you can see how that would go right to the bottom line. They engaged in financial engineering of the balance sheet, the thing that's familiar from financialization, and they used stock buybacks to raise share prices. And I'll show you a little bit more about stock buybacks in a second. The document, this is the impact on the American stratification system by all of this was really extreme. And I just kind of note that, the rise of the 1%, the stagnation of wages, the cuts in pensions and healthcare benefits that occurred, the deindustrialization that is the basis of our current politics, the creation of globalization and supply chains, and then the growing insecuritization of work. In America, almost every worker can be fired today, right? You can walk in the office and they can say, you're done, we'll send you your check. And the rights, that's the only people left, I think, are as tenured professors. And there are very few people in America who have much labor rights, okay? And this really dates from some of this period. So let me just show you some numbers because they are kind of dramatic. You may have seen things like this. So before 1980, wages tracked productivity in the United States. But after you get shareholder value, all of a sudden, they're kind of going, well, look, if we increase productivity, why should we pay that to the people working there? And you can see that between about 1980 and 2013, when this series ends, you can see that hourly wages go up 108%, which means they haven't gone up at all, whereas productivity has gone up to 2.5 times. And so where's that money going? Well, it's going to the bottom line. It's going to the shareholders. This was this thing I was talking about. This is a chart. There's different ways of doing this chart. This is the ratio of CEO pay to average worker pay. Again, if you go back to 1980, you can see it's about 40. 1981 is the date on here. It starts to rise in the 90s, and it takes off in the early 90s, right after this kind of truce got formed, and you can see where that goes. So, and then, here's what they got, right? Again, you can see the same kind of patterns. You can see the growth in that this is CEO pay. You can see a lot of it's in stock gains and other forms of compensation. Salaries go up. Your average CEO at the end of this series is making something like $10 million a year in a publicly held corporation. So, maybe you've seen these graphs before, but you have to understand how dramatic this is, right? This was really transformation, right? This is a familiar Piketty graph, which I think probably many of you have seen versions of these graphs before, Piketty and Saez. You can see that the top 1% and the top 0.1% back in the 70s was making about 5% of all the income in the society for the 0.1. For the top 10, it was about 10%, and this is now over 20% for the 1% and about 10% for the 0.1%. Those numbers have bounced around a little bit, but that's about kind of where they are now. So how do you do this? Well, one of the ways you do it is so in the United States, let me explain, our health insurance mostly comes through private employers. So we have a public system of health insurance for retired people and for poor people, but everybody else gets their health insurance at work, and that's 60-70% of the population. And of course, corporations can pay however much they want or do whatever they want. They can reorganize these plans because they run them. And one thing you can see here is that full-time workers have still about, what is it at the end, 60% of them have coverage in their jobs, but that means a lot of them don't. And part-time workers, it's down to about 15%. So, again, if you're worrying about the bottom line, one of the things you can do is reduce the payments you're making to workers in terms of benefits. The other place this shows up, and here's another version of that. This is actually a little more even contemporary. If you look at college graduates, this is young people. What you see is that 60% of them had such benefits in 1990. By the time you get to about 2013, it's down to 31%. And you can see people who are just high school graduates, it's down to 14%. So you just say, how do you make money? This is how you make money, right? You take it, it's a way to make money. So this isn't just financialization in the kind of Epstein sense. This is exploitation in whatever you want to call it. This is hard to explain. In America, we have a very crazy pension system. And we all get something like Social Security, but it isn't very, let's use the word generous. And most people have a lot of people have some kind of private pension. And before shareholder value capitalism, think about that from a corporate point of view. You have agreed when a bunch of people retiring who are no longer contributing to the company to guarantee them a certain amount of money. So there was this massive switch in the United States to what are called defined contribution pensions, which mean that each individual now has to save money and put it into a stock account of some kind and hope at the end there's going to be enough money there for their pension. So we've all moved. So you've shifted the risk from the company to the individual. And this was all sold to Americans as, well, this is a really good thing. When you change jobs, it'll go with you, blah, 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 blah. But the impact of it, you can see the red line is where it went. The impact of it from the point of view of the firm was a massive decrease in the amount of money they were paying on pensions. This takes me to the point I was making right at the beginning, which is this constant need to invent new strategies to raise stock prices. And I think if you go back to the 1980s, that's when you get this downsizing, outsourcing, breaking up companies. In the 1990s, you get this cutting benefits, reducing the number of managers. And then in the 2000s, and this is where I think that shareholder value capitalism has been morphing, we see two things going on, a bunch of things. One is there's been a huge concentration in the American economy where people have been buying up their competitors. And most economists actually who study industrial organization economics in the United States believe that one of the reasons productivity has slowed down is that this increasing concentration has created oligopolies. The other thing that's happened is a lot of publicly held companies have been bought up by private equity. And private equity runs companies in a very different kind of way. And so this kind of basic logic of shareholder value is kind of receded a little, whereas these are new kinds of tactics. You can sort of see that. And then I want to say something about stock buybacks. So here's a graph from 2010 to 2018, 16. And you can see that one of the things that drove the stock market. Many of you who follow such things maybe know that stock markets in the United States have until the last 4 months. And one of the things that's driven them is stock buybacks. And what companies do is they buy back their own stock, which raises the price of their stock. And if you're the CEO, what it means is that your target gets met and you get your compensation and life is good. And you can see how the two graphs kind of follow each other. Also, how do you do this? Well, you can see here that a lot of this is done with debt. So, follow me here for a minute. When interest rates were low, a corporation, when interest rates are 1 or 2 or 3%, borrows $100 million, it buys back its stock, it has this low debt, and the stock price goes up. Boom, everybody's happy, right? And I don't know, maybe they do that in France. And finally, this one is being one of my favorites. Some of you may remember that in 2017, Donald Trump, his only real policy that he actually ever passed was to cut taxes for corporations. He cut $1 billion. And if you look at this graph, what you can see after 2016 is this big bump in stock buybacks. It's been estimated that somewhere between 40 and 60% of that tax break went into stock buybacks. And here's a funny slide that someone put together about California, since I'm from California. And you can see the California companies, this was actually based on tax records. This could have saved about $55 billion, and here you see $21 billion of it went into stock buybacks. And I'll end that by saying shareholder value is alive and well, yes? Boom. Okay, so I'm going to spend about 10 minutes talking about financialization, and then I'll kind of move towards a wrap up here. So I'm going to head, these definitions of financialization were actually your first two, so I won't repeat them. The increasing role of financial motives, markets, actors, and institutions. So what is the link between shareholder value and financialization? And I want to, for the next few minutes, explore this. I think it's really murky. That would be I think this is one of those things theoretically that we should all begin to think about or try to think about. There are people who think that shareholder value capitalism is identical to financialization. There are articles where people have written that. There are people who think that shareholder value begat financialization. And then a lot of the people who do financialization, particularly the economists who do this, the heterodox economists, as they're called in the United States. I don't know what they call them in Europe, but they're called heterodox in the United States. They've kind of ignored the whole shareholder value thing and seen this as the rise of the financial sector and the financial sector's dominance. And so what that interpretation of financialization is kind of the one that they've propagated. And I don't think, so you can see that we've got stories everywhere, right? We got the same thing. We got that shareholder value capitalism doesn't matter, or is it best a variety of financialization? And we got that shareholder value begat financialization. And I think all three of those stories are out there. I think you can recognize that, right? People can sort of see that. There are points of convergence. I think everybody agrees that the 1970s produced an economic crisis for capitalism. When you talked about Fordism to financialization, that's what precipitates it. I think everybody agrees that financial criteria are used to evaluate the performance of companies. I think everybody agrees that those who the rising share of the 1% is about financial gains. And I think a lot of people think that asset owners have been the principal beneficiaries of this change. And obviously everybody else kind of had wage stagnation. And so I think those are things that both agree. If you listen to what I was showing you, I think it could see the way those things are similar. I think there's points of diversion. And let me say that I think from the point of view of a lot of the macro conceptualization of financialization, shareholder value is simply one kind of the growth of the power of the financial sector. And I do think that this is an interesting question about the relationship between the financial sector and shareholder value and the degree to which they're two different things or the same thing. And I think that the financialization literature has, I think the bulk of it has viewed that it's the financial sector that's driving this, that's driving these tactics. I think shareholder value capitalism, on the other hand, isn't seeing that it's finance per se that transforms capitalism, but the transformation of corporate governance through the realignment of power between management and shareholders and the construction of strategies to increase the return to shareholders. And that's a different mechanism, I think, if you think about it. And I think you were alluding to that it's, we didn't coordinate. It was kind of interesting that you said all that, because we didn't coordinate, but I think that's right. I think that distinction is correct, that we do have this difference of opinion. Financialization, as I said, argues that power of finance now dictates corporate actions around the world and focuses on financial motives, how they're operating to structure non-financial firms. I wanted to just show some data, that's kind of consistent with that argument, that this is U.S. data that's a little bit consistent with that argument. And one of the ones that this first graph I think is really interesting, which is the share of profits that go into the financial sector versus the manufacturing sector versus the service sector in the American economy. And one of the things you can see in this graph is if you go back to about 1980, you can see the financial sector had about, 15% of the profits. The financial sector here is called FIRE. That's the way they talk about it in America. It's finance, insurance, and real estate. So it's those three industries lumped together. And the number of people employed in these industries is about 10 or 12%. And their share of profits in this period fluctuated between 10 and 15%, suggesting that they were getting about their amount per what they were doing. What happened in the 1980s and on is you can see this rises very quickly. It peaked in the early part of the 21st century at about 40%. In the financial crisis, it went down, but it has now come back up. And so the financial sector in the U.S. is raking in something between around 35% of all the profits in the American economy, with about 10 or 12% of the labor force. So that fits, I think, the kind of financialization argument. Secondly, finance share of compensation. One of the things that people have also tracked is how much money do you make if you work for finance. And if you look at this graph, this looks at sort of the average salaries in finance compared to every other field. And you can see that finance did a little bit better from, what is that, the 1950s to about 1980. But beginning in 1980, you can see it takes off. And by the time we're about through shareholder value, you can see that now they're making about 170% of what the average salary is. So this is across all salaries. And those are kind of, I would call them factoids that support a kind of financialization argument of a finance driving stuff. But if we go and look at who are the richest people in American society, one of the things that you can see is that the richest people in American society are executives, managers, supervisors, non-finance. And they are about, at the end of this data stream, 42.5%. They've dropped a little bit over the course of about 30 years. But most of the richest people in America are working at high levels of management. That's who they are. But there has been an increase in finance, and you can see the finance professions went from about 11% to about 18%. And so those two stories are out there, and you can see they're complementary more than they're contradictory. So I think that shareholder capitalism, this is kind of a conclusion of that, is there's evidence it's spread a little bit, the UK, Canada, and Australia, because they do have markets for corporate control. But I think also, and I think this is one of the things that's been kind of hard for this financialization thing, is that there has been a persistence in Europe. I mean, ever since I can remember, Europeans have been talking about the demise of the European welfare state. And there are always pressures on the welfare state. So I'm not underestimating those. But the reality is that, you know, you just saw what I showed you about the American welfare state under shareholder value capitalism, right? And you know, I mean, I know pressures, I know there's lots of things that have happened in Europe, but it's not been the same, right? The same thing hasn't happened. And I do think that to some degree the varieties of capitalism have persisted, so that these national systems have been adjusting, but they haven't entirely disappeared. And I think that some of that has to do with I think the fact that shareholder value capitalism is a particularly vicious set of practices, let's just put it that way. There's been more income inequality in Western Europe, but nowhere near as there has been in the United States. What I think this all means is that research should put these two perspectives into dialogue in a more effective way. And I just pose a couple of questions, which I started out with as well. Did shareholder value start the use of financial analysis in managers in finance, or was there some kind of coevolution? And I don't think we have a lot of good stuff about that, about this coevolution between what's going on with institutional investors and what's going on with managers. And I do think eventually managers do embrace it, and then they start to be trained in it, and then they don't need any help. I also think that financial institutions don't have the capacity to engage in strategic planning, and so they're looking at these things, these stock analysts, and they're making judgments based on, you know, kind of their intuitions. Shareholder value strategies have changed over time, and is there evidence that the financial sector spreads such tactics? So, for example, stock buybacks are a very effective way of raising share prices, and the degree to which that has or hasn't spread says something about the nature of the relationship between these innovations that are occurring under shareholder value capitalism and financialization, and I just don't know the answer to that question. What tactics are distinct to financialization, and how can we trace their spread across industries and countries? and how do the spread of financial products fit to the narrative? Let me just say something about that one. So one of the things I think is that one of the great reasons why I thought shareholder value capitalism was dead in the United States is that financial institutions right around 2001 became uninterested in corporations. They became interested instead in financial instruments. And what they started to do was invent all those things that ended up in 2009 melting down the world economy. And that's what they were doing. That's what the largest American financial institutions were doing, where they were creating mortgage-backed security and all the basic financial instruments that were based on that. And so they kind of stopped caring. They stopped being a presence or a pressure. And I think that it's an interesting question there about what does that mean about financialization? If financialization is really the financial sector inventing its own things to create its own wealth and isn't really about them telling managers what to do. I think this it means we should explore this connection. I recently read a paper about consumer credit in different societies where someone was claiming that Danish society had become financialized because Danish households now had a lot of household debt. And the problem with the paper was that the Danish government decided people should buy houses, and so they helped them subsidize the buying of houses because they understood that it creates wealth for families. And people were able to take on the debt because they had an extensive social safety net and they didn't have to worry about it. And so most of the debt that was being taken on was for housing. That was also true in the United States, that this whole narrative about what happened in the United States is because the welfare state sucked, that everybody had to go out and take on debt. That's not true. The evidence for that just doesn't exist. What happened in the United States is that upper middle class people borrowed money and bought bigger houses and remodeled their kitchens. That's what happened in financialization. And so American households were not financialized at the bottom. They were financialized at the top. And that is a very different kind of dynamic. And I think paying attention to all that is something that makes sense. Now I'm going to go to my conclusion. So, is shareholder value capitalism over? So in this paper, we talk about this demise of Jeff Bezos, who until last year was the richest person on the planet, guy who invented Amazon, religiously didn't care what the stock market thought about him and spent 20 years doing what he wanted to do to build Amazon the way he wanted to build it, didn't pay any attention to them, and that's a kind of line that's out there. Shareholder value as an ideology is under attack from stakeholder capitalism. The World Economic Forum, the organization of the capitalist class that meets every year in Davos, has officially come out for stakeholder value capitalism. I don't think it means much, but they have. And as I was mentioning a minute ago, finance has moved on. So this looks like shareholder value capitalism kind of, does everybody kind of get it? Is, maybe it's vetted date. But I would say that, again, if you start to go underneath the surface here, the values of shareholder capitalism are institutionalized. The American workforce does not expect job security, high wages, or benefits at this point. Shareholder value capitalism isn't shareholder value capitalism, it's just capitalism in the United States. And if you talk to your 20 or 30-year-old children, you hear this all the time. Stock buybacks suggest stock price can still matter. I would also say private equity operates in a way that people in the 1980s would have found pretty easy to understand. You borrow a lot of money cheaply, you pile on debt, you work those assets until you get it back, and then you sell the thing back into the market if that's what your goal is. Sounds a lot like shareholder value capitalism. And of course, the point of Silicon Valley is for founders and venture capitalists to cash out by by taking companies to market. I think this suggests the enduring legacy of shareholder value. The forms of this system have changed, but the notion that owners have priority over stakeholders and the evolving tactics have remained. While many of its core ideas have become standard operating practices, shareholder value continues to produce new innovation and twists on its basic logic. So the decrease in the number of publicly held companies is due to a merger movement partially. It's also due to the takeover of these companies by private equity. And I think those two things are things at this time that we haven't paid as much attention to in the American economy. Is what does that mean for where the American economy, what's going on out there? And there has been this increasing concentration of production and reduced competition. And it's quite interesting that many of the economists who went to work for the Biden administration have propagated this point of view. And so you may have noticed that Americans at least are rattling the sword about more antitrust. And the reason is that I think there's grown to become a consensus that there is less competition because of this. So and you make more money. There's Peter Thiel, who is a very famous venture capitalist, has this video, which you should go watch on YouTube, which is about, essentially, competition is for fools. And then what you want to do is you want to find a monopoly, because that's how you make money. It's a great, he gave this lecture in front of a class at the Stanford Business School. It's a great clip. If you've never seen it, you should go watch it. Go see what I'm talking about. Has American capitalism created a new form? I think that's an interesting question. I leave it there. Thank you.
Thank you.